The average price for gas in the US rose to over $5 a gallon recently, for the first time in history. Unfortunately, the price at the pump is likely to keep going up. Market participants love to say that the cure for high prices is high prices. But these days, the oil market isn't providing that cure. I'm going to explain how an imbalance between supply and demand is keeping oil prices high, why that imbalance hasn't been corrected by the market so far, and what that could mean for oil prices going forward. As COVID restrictions are lifted and more people start returning to the office and taking summer vacations, demand for oil has been picking up steam. That has helped push crude prices to well over $100 a barrel, and gas prices to a record high. The price of oil isn't directly responsible for the price of gas, though. President Joe Biden is making the case that a big part of the jump in prices is the big profits of oil refiners. He sent a letter to 7 major oil companies that said, in part, since the beginning of the year, refiners' margins for refining gasoline and diesel have tripled. David Kelly, chief global strategist at JP Morgan Funds, recently calculated that oil companies' profits on each gallon of gas were the highest in history. And that's helping turn oil companies' stock prices around after years of struggles. The S&P 500's energy sector has risen by around 50% in 2022, while the overall index has sunk by around 20%. Now, typically in business, the best way for a company to maximize its profits is to produce more while prices are high. When prices rise, companies increase production. That increases supply, and eventually supply outstrips demand and prices fall. But that's not happening right now in much of the oil sector. And there's a reason. After some tough years, including a historic price collapse in 2020 that sent crude prices into negative territory, US oil companies have changed their approach to business. New securities filings show that top executives at major publicly traded oil companies like Pioneer Natural Resources and Occidental Petroleum are now being rewarded for keeping company costs low and returning cash to shareholders via stock buybacks and dividends. That new approach has meant less drilling and more focus on keeping stock prices high, profits flowing, and investors happy, according to reporting from my colleagues Ryan D. Zember and Matt Grossman. Worker shortages and high input prices have also made drilling less attractive. The change is so widespread that a recent survey from the Dallas Fed asked how high oil prices would need to get in order for companies to go into growth mode. And almost 30% of oil executives said price didn't matter. Around 60% of the executives said that investor pressure to maintain capital discipline was the primary reason companies weren't drilling more, despite skyrocketing prices. The US is now the world's top producer of oil, so American companies' preferences play a major role in the supply of oil. Half of all large firms in the Dallas Fed survey said they expect to pump either no more oil or just 5% more oil between the fourth quarter of 2021 and the fourth quarter of 2022. OPEC, the world's largest consortium of oil-producing countries, has also held back on flooding the market with oil. Russia's war with Ukraine and the resulting sanctions and embargoes on Russian oil have further put a crimp in supply. With supply being held down, it will likely take a fall in demand to decrease the price of oil. And unfortunately, that typically comes with a recession. Oil companies are doing what Dreamville MC Loot says. He notes, when you're chasing after dividends, you always check the price. Story of my life. The way it came around the first time won't come back to you twice. That's all for now. I'll see you next time.